Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research on over 5,500 stocks and ETFs. With me today is David Blake, CMT, here to discuss what happened in the market last week and what we should keep an eye on as we continue into this week's market. David, how are you today?
I'm doing well, thank you.
Great, let's jump right in.
All right, well, we've had 3 weeks now of pretty powerful gains in the major averages. And then last week, again, it's kind of stalled out a little bit. We had ended up with a mixed market, but we had, again, several all-time highs. We had the NASDAQ, the S&P 500, NASDAQ 100, the transports, the Russell 2000, and the Philadelphia Semiconductor all strike new highs at some point during the week, with several of them hitting new highs as we finished up. Okay, we're in earnings season, and then we also have the headlines coming out of the Middle East, and that's basically what we're trading off of. Now, earnings, what I've noticed here recently is it's really a hit or miss. If you miss, you're in trouble because the bar is set pretty high for this quarter for everything, especially the tech companies. But so far, so good. Now, we had last week, GE Vernova came out with blew away earnings. United Health Group was strong. Boeing was strong. We also had Texas Instruments, and of all companies, Intel came out, and they really blew out their earnings, especially with their forward guidance. And I think Intel is now at a new high. It's almost doubled in the last several months here. So that's something new to keep on our chart. I think a part of that is that they're building the chips now. We had the semiconductor index surge 10% just last week alone. We've been talking for several weeks here that we want to be in the semiconductors, and hopefully you have been in some of those stocks. I think that we'll see how much further we have to go. We'll talk about that a little bit later. But if you're reporting strong earnings, you're being rewarded. If you miss something like, say, Tractor Supply or Charter Communications, ServiceNow, stocks like that, they're going down 15, 20, 25% when they disappoint. So it's a have and have not type of earnings season right now. While we're talking about earnings this week, we also will have 5 of the Mag 7 companies reporting. Let me see here. We're going to have Alphabet, Microsoft, Meta Platforms, Apple, and Amazon. And as I mentioned last week, again, the bar is set high for these companies, and they've had some pretty strong move up into them. So I think the risk is more if they beat, you'll probably get a little bit of an up move. Maybe they stay flat. If they miss, they're going to get hammered. But I don't really think we're going to see any of those companies miss. So I think that should keep a floor into the market going over the next week or so. Let's see, going on here. Now, one thing that is concerning, we are starting to see a little bit of negative divergence show up in some of the internals of the market. Last week, only 5 of the 11 sectors closed higher. So that's just showing that the gains that we're seeing here now are being made by a more select group of stocks, okay? And that's something that you don't want to see. You don't want to see the generals march alone. You want to see everybody a broad-based rally, especially after we've had a big run. That means people are thinking the other ones are fully priced. You also had NYSE and NASDAQ advanced decline lines tick down a little bit. Not a lot, but they are showing that there's a little bit more stocks that are being under distribution, which again is starting to show that people are coming off the sidelines a little bit. As far as the technical condition goes, I mentioned as a Friday, it's still strong, but we are overbought. What overbought means is the stochastics are up in the 90s. We had the 14-day RSI, I think on Friday was up above 70, 75 or so for some of these. So that just means that we're probably due for some backing and filling. And of course, with earnings and also with the headlines from the Middle East, it's very easy to get that backing and filling. Now that today we're flat to a slightly mixed session today. And again, that's basically because the talks with Iran and the United States have stalled. Trump says, make us a call. The Strait of Hormuz is still closed. That's weighing on growth in Europe and also the United States. We'll see how that plays out. It's going to be hard to keep on rolling higher as long as that thing stays closed, because energy is in so many different products, the oil that we're getting out of that. So while we're up here at new highs and nothing's really changing, and that war is going on 2 months now, that may be starting to limit the upside. So we want to be careful that we're not continuing to chase positions in here. Also, a couple other things on the technical condition, the secondary indexes, which I like to see lead the market higher or lower. We saw the Russell 2000, the transports, and also the semi index all outperform again, and that they're leading the market higher. We want to make sure that they don't start to roll over before the rest of the market. That would be a signal that we got to kind of watch it. Now, another thing I noticed as far as not really negative divergence, but it's something you don't want to see. As of Friday, we only had 2 of the 11 sectors making new highs. You have all these indexes making new highs, but only 2 of the sectors are making new highs. And that's technology and real estate. Now, several of the other ones, let's see, industrial, communication services, consumer discretionary, and materials, they are above key moving averages, but they were lower on the week last week. So they may have any sell off here, they're going to come down and probably test their 50 or 100-day moving average. We want to make sure that they hold that. And if when you see them come down there, you may want to see if it's going to bounce off of that. If it slices through those moving averages, you may want to, again, just take a little bit of a step back. So we'll see how that goes. Underlying breadth, I just mentioned, we are seeing a little bit of sell-off in the advanced decline line. We had a lot more new highs and new lows on the NYSE and the NASDAQ last week, especially the NASDAQ. But the NYSE is still a little bit anemic. I think we had about 300, which is more than I thought we were going to have because we never had more than 158 in one day. So you'd like to see that expanding. Back in February, the NYSE was having like 300 a day of new highs. And that's more what you want to see if we're going to continue to break out the new highs. Investor sentiment is neutral. However, we are starting to see a lot more people starting to jump into the bull camp. The American Association of Individual Investors, that's retail investors, they saw the bulls jump to 46% from 31.7 the prior week. And that's a big jump by the bulls and bears. And that's also the most bullish we've seen retail since mid-January. Then we also saw the hedge funds, the National Association of Active Investment Managers Exposure Index. They jumped from about 69.4% a week or two ago all the way up to 94.2. So the last week or so, they've pretty much gone all in, which can be good. And we talked a little bit about that last week, that when they started to come in, that was probably going to boost the market higher because you had 30% cash in the professionals. They're going to put that money to work. That was going to be a lot of funds flowing into the market. I think was what we saw happen here the last week or two. So they're pretty much all in. I did want to mention, again, a little bit of a negative divergence that we're seeing here. And that's because the CTI is scheduled to go to a negative reading. And sometimes when we go from a positive bullish market posture, when the CTI goes negative, some people will call in and they go, should I sell everything? You're going negative on the market. If we go to a negative CTI, it doesn't mean that week we have to go to a sell in the market. We probably will go to a neutral, which makes sense here. We're pushing new highs and we're starting to see negative divergence showing up. And the reason that the CTI is scheduled to go negative is because we're getting towards the end of a 4-year cycle here in the market, and you're starting to see the longer cycles exert more influence over the market than when you're just starting out, when you have a trial and then you bounce off that trial and head higher. So that kind of indicates to me that we could see things go sideways up here for a little bit, maybe even kind of see the market take a little bit of a rest. Now, the rest of this week, we have FOMC meeting starting tomorrow. Right now, there's a 100% probability that Powell will leave rates alone on Wednesday. That comes out at 2:00. Then Powell will have possibly his last press conference at 2:30. He's not going to want to rock the boat or anything going into that. So don't expect much there. I don't think the market is going to want to rally or sell off on anything that the FOMC does, because it's pretty much, like I said, 100% probability. So we won't see much going on into that. And other than that, we'll keep our eyes on the headlines for the Middle East. I think if we somehow see an opening, I think you'll see stocks and the major averages take another leg higher. If not, I think we just do some more backing and filling at this point. And then also with 5 of the Mag 7 reporting earnings this week, that's probably going to increase volatility, especially if we see one of them really blow them away or one of them miss and guide lower. Also, investors will be watching the CapEx spending from those companies, what they're projecting to. That may weigh into how we see the stocks react to that. But other than that, just for the rest of the week, I think we're going to be kind of stifled by what goes on with the Strait of Hormuz. Because with the talks stalling, that kind of gave us a little bit of a push towards the end of last week, when they thought that perhaps we could see a little brighter outlook for an opening there, but we didn't get that over the weekend. So We're staying bullish for right now, but if we can't break out the new highs here soon, then I think going to sideways market, we'll probably see a little bit sideways and until we can get another catalyst. And then again, with the CTI cycles, they're probably looking at maybe more weakness going into the summer. So we'll have to see how that goes. If the indexes break through their FLDs, which are the future lines of demarcation, that would be a sign that we could see more of a sell-off. But until that happens, the posture will probably stay at least neutral to bullish for the next week or so.
Very good. Thank you so much, David. If you have questions for David or anyone on the MarketEdge team, feel free to send us an email to support@marketedge.com. Or drop a comment below if you're watching on YouTube. Your first 2 weeks of technical analysis are free on marketedge.com. Give us a try and we'll catch you next week. Thanks, David.